First, the distinction of economic and accounting profit. So first, let me start by defining profit again. I will use the Greek letter pi to represent profit in a particular market or in a situation. And profit most generally is just defined as the total amount of revenue that's earned by the firm. And this will often be given by the price of the product times the quantity that's sold in the marketplace. We've already looked at that diagrammatically because we looked at a demand curve, remember, last time. And we said, take a point on the demand curve that's going to specify a particular price and a quantity that would be purchased by the consumers. And if we take that price and multiply it by the quantity of the good, that's going to give us the total revenue that's being earned by that particular set of firms or the producers in that particular marketplace. All right, but then we're going to have to subtract off from that total revenue. That's how much money they make when they sell their products, but they have costs that have to be incurred. And so we're going to have to subtract off all of the cost reduction in order to evaluate what the total profit, the return to the owners of the firm are likely to be. And here I should point out that we're imagining now that we have a free market capitalist economy, which means that the means of production, the capital equipment, the store, the business where the company is operating, the factory space, all of this is owned by individuals. They own the firm, and therefore they are entitled to the profit or any extra money that comes from the sales above their costs of producing that particular product. All right, and we're going to imagine, ultimately, that what firms care about is to maximize or get the profit they possibly can. And we're going to think about what the implications of that is likely to be. Okay, so accounting profit. So accounting profit is going to include, I'm going to use the term explicit dollar costs only, okay? And that means explicit meaning they're easily recognized, easily measured, and it's what we typically would think about in evaluating the cost of the production process. And so those costs are going to be the cost of labor or workers. You're going to have to hire some people to work in your factory maybe, or work in your retail store, whatever that business may be. And you're going to have to pay them a wage. All right, and based on how much time they devote to the production process, your costs are going to be incurred. You also have capital equipment. And when I use the term capital, I want to highlight the fact that we have different usages of the word capital in economics. Okay, so sometimes capital will refer to financial capital, and we'll use it in conjunction with discussions about, money in the bank kind of thing. And you've got capital that can be used to help spur investment, for example, for a company. All right, and that's a legitimate way of defining capital, but it's referring to financial capital as opposed to what we're thinking about in context here, which is physical capital. Right? And physical capital means machinery, equipment, office space, factory space, any kind of equipment that gets used in the production process, what we're referring to as capital equipment, okay? And you've got to pay for that equipment. Somebody owns it. Often the owners of the firm are, in essence, owners of the capital equipment that's necessary to produce the products in question. And so the return on capital is often closely associated then with the profits that are being earned by a particular company, okay? Now, the last thing I've got listed here is intermediate goods, and that's going to be, the inputs into the production process. If you go back to the iPencil production process, you remember that the pencil requires graphite, it requires cedar from trees, it requires metal or tin, it requires rubber. So those materials have to be brought into the factory and assembled and made ready in order to put through the production process in order to get the final completed product. And you have to pay for those intermediate goods in order to get to the final conclusion. And those correspond to some of the costs that have to be incurred by a typical business. Now, what accounting profit does is it measures all of those listed costs that you can evaluate and keep track of on a day-to-day, month-to-month basis. And you take your total revenues again, and you subtract off your total costs, and you get what's recognized as accounting profit. Right? But now we want to make a distinction between that and what we're going to call economic profit down below. Now, economic profit is going to include both the explicit dollar costs and so-called opportunity costs. right? So let's go into a little bit of what that presents or corresponds to. Oops, wrong direction. Now, over the course of several, I've been teaching principles of micro for about the past 10 years at GW. Before that, I was almost exclusively teaching international econ. But I discovered in looking at different textbooks that there's the potential for some confusion here. And I'm going to clear up that confusion, which you may not have yet. But just in case you come across this, I want you to recognize that there's an issue out here. Okay, and the issue has to do with that different textbooks will tend to provide two different definitions of opportunity costs. Each of them are perfectly valid, and you could do it either way. It's just a matter of what you've decided to define opportunity costs as. All right, now I've been used to, and typically have been teaching it this way, using this first method up here at the top. I call it OC1 here. And this is the value of the next best opportunity, and it's usually associated only with the implicit costs, the cost that you're kind of incurring because you're not doing something else instead. All right, and that's how I would think of opportunity cost, and it is one definition of opportunity cost that gets applied in textbooks. But there's another definition as well. And the second definition is to include in opportunity cost, not just the implicit cost, which I'm going to give you a clearer description of in just a minute, but also the explicit costs like labor and capital that I just described. And basically, OC2, they say opportunity cost is the cost of thing you have to incur in order to produce a particular product. Okay, now, one of the reasons I want to highlight this is to emphasize a particular issue or problem that might arise. So for example, you're going through you're learning economics from me, and I'm teaching you in a particular way. Oftentimes, it's closely associated with what you're going to see in other textbooks. If you go to the internet and you search for example, economic profit and opportunity costs, you might come across usage of the second definition, whereas I'm presenting and talking to you about the first definition, and there's likely ultimately to be confusion as to, well, how are we supposed to define this, which is the right way to do it? The answer is there's no right way. There is just, you define your terms, you make your assumptions, and then you go forward on the basis of those assumptions. But sometimes observers will use different definitions of specific terms, and terms themselves don't always have a strict definition that's applied in the same way by all observers. It's important to recognize that. So a lot of times, arguments about policy issues, interpretation of data, understanding of the world around you, people can have very different opinions about things, seemingly, because they're using different definitions of key terms. And until two people come together and sort of define and recognize, well, which terms are we using? How are we defining these terms? Can we really get on the same page and make fuller understanding? So let me give you an example of this, which is we're going to come back to later. Earlier in the course, I showed you in the second lecture, I think, I showed you a video with Joe Stiglitz talking about the invisible hand and Milton Friedman talking about the invisible hand. And each of them were coming to a completely different conclusion about that. Stiglitz saying the invisible hand looks invisible because it's not even there. It doesn't exist. And Milton Friedman saying, no, the invisible hand is as important now as it ever was. Two completely different conclusions about the invisible hand. But the reason they come up with those two different conclusions is because they have different definitions they're using for what invisible hand means. And I'm going to come back later in the course, and I'm going to emphasize that particular point and show you why both of them are correct in their observations, as long as you take as given their particular definition of the invisible hand. But because they have different definitions, they arrive at different conclusions. Now, in our case, it's not going to matter too much which definition you use, because either definition is going to give you the same measurement of economic profit. It's just it's just in terms of what you define as the opportunity cost. So it doesn't really, in this case, affect the final conclusion in calculating accounting versus economic profit. I'll show you in just a minute. Okay, let me give you an example to make this much more concrete. Suppose you've got a gift shop that's owned by a sole proprietor. And a sole proprietorship, that's described a little bit in the notes, is just when you've got one individual who owns his or her own company. All right. And let's suppose that the gift shop is in a building that happens to be owned by the sole proprietor. And let's imagine, just for simplicity, that there's no mortgage or no monthly payment in order to maintain that particular property. I'm going to ignore property taxes and other issues like that to keep the story really, really simple. So let's say you're using capital equipment now, this building, to run your gift shop, but you have no monthly payment to be made for that, okay? Now, suppose this gift shop is able to secure and sell $150,000 worth of goods and services, goods during the year, okay? Let's just bundle together all of the expenses of the gift shop, the intermediate goods, the electricity, any expenses that they have in running this particular business, and let's assume that that amounts to $80,000 per year. Okay, again, I'm making up some numbers just to illustrate the points that I'm trying to make here. All right, let's suppose the store rental. And here, when I'm thinking about store rental, I'm imagining that you've got a gift shop, a storefront that, looks out to the sidewalk, for example, on the street. And you can run your own gift shop in that. But if you didn't run the gift shop, you could rent that space out to somebody else who would run maybe their own gift shop or something else instead. But then they would be responsible for the business, and you would just be collecting rent on the property that you own and the use to which it's being put. All right. And let's imagine that that store rental, if you rented it out to someone else, it would be $30,000. Okay. Now, let's also take the owner, the sole proprietor, and let's evaluate what he or she would make in an alternative job working somewhere else. And again, I'm making up the numbers here, but let's just imagine that the best this person could do elsewhere is to make $30,000 per year in a different job. All right? Now, let's put all of this together. Accounting profit. How do we measure the accounting profit of this particular business? Well, we take the total revenues, which is $150,000, and we subtract off the total explicit costs, those monthly expenses that you have, which are $80,000. And that amounts to this $70,000 profit, which would be recorded by the accountants for your individual business. And because this is a sole proprietorship that owns this particular gift shop, that $70,000 profit goes into the pockets of the owner. All right, so we could think of it then as the salary to the sole proprietor, the owner of the firm. All right, and you can say, okay, well, how much do you make running this business every year? And here's where you got to be careful, because sometimes when you talk about a business and its operations, sometimes when you say, well, how much do they make a year, they're going to report the revenue. So if you look at, for example, Walmart, and you look at their revenues are enormous, much more than their profit, because their revenue is all of their sales. But they had to buy all those goods that go into that they're selling, and what they actually take away is only a smaller margin at the top of that. You've got to subtract off the costs of production to get really how much money that firm is making, and that's going to be the measurement of profit that accountants will come up with. And it's also the number that you're going to have to pay taxes on, presumably. Okay, but now let's look at economic profit, which is just a little bit different, because here what we're going to do is we're going to include the accounting profit in there, the 150 minus 80. But then we're going to subtract off the implicit costs, the things that you're giving up in order to do the thing that you're doing. And in this particular case, the individual is giving up an alternative life, which would involve this owner going to work every day and making a $30,000 a year salary. But presumably, if they went off to work in another company somewhere else making $30,000, they would have an empty storefront in front of the building that they own. So why not rent out that storefront to some other business that wants to run a particular space? All right, and how much would they make? They'd make $30,000. So your alternative income for this individual, we're imagining, is the $30,000 salary plus the $30,000 rental income, which amounts to a total of $60,000 that they could earn in this alternative scenario. And this measurement here, the 30 plus 30, $60,000, is what I'm going to define as OC1. It's the value of the next best opportunity. You're subtracting off the rental because this is something you're giving up in order to do the thing that you're doing. Okay, so it's a cost associated with it. A cost is something, in this case, something that's foregone. You're not able to do this, you're not able to work in this alternative job, and you're not able to rent your store out, so you're giving up that $30,000. And that's why we're subtracting it off. But that $60,000 is going to be the measurement of OC1, the opportunity cost measured in the first way. But if we were to measure opportunity cost in the second way, on the previous slide, we would add in the 80 here, and we would make it 80 plus 30 plus 30, which would be equal to $140,000 instead. So the alternative opportunity cost measurement is to say your opportunity cost is $140,000, which you then compare with your revenues of $150 and get your economic profit of $10,000. If you use OC1, then you're going to start with your accounting profit and subtract off just the $60,000, which is the implicit cost that you're giving up in order to do what you're doing. I calculated OC2 by adding in both, going back one slide, by adding in both the explicit costs, labor, capital, intermediate goods, and the implicit cost together. So the explicit costs are what you're measuring in the accounting profit. That's the $80,000. The implicit costs are these here, $30,000 for the rental and the $30,000 income. So you add all that together to get opportunity cost 2 definition. You don't add in the 80,000 if you use just what is the next best opportunity, what am I giving up basically to do what I'm doing. Again, like I said, either definition is fine. It's just a different way of defining, you know, your next best opportunity, if you will. And they're both going to get us to the same answer, which is economic profit is $10,000. Now, let me highlight then what we're imagining here. The reason we think economic profit is important is because economic profit involves not just how much you're making in your current profession or your current occupation, your running of this gift shop, but it's also taking into account what you could have been doing instead. And by following profit and saying, I'm going to try to maximize my economic profit, that's equivalent to saying, I'm going to try to make the most money I possibly can amongst all of the different outcomes or possibilities that I have available for me. And if you want to maximize profit then, namely economic profit, you should be choosing that profession or occupation, that task, which gives you the greatest amount of money possible. You should try to make as much money as possible is what we're saying here. So let's say you've got an individual who's good at doing lots of different things. And let's say that they could run a gift shop and make $70,000 a year counting profits. But they could do something else and they could make $60,000 a year, or they could make $50,000 a year doing occupation 3, or they could make, all sorts of different possibilities. When we do this economic profit comparison, the opportunity cost has got to be the next best opportunity. So you might have 10 other opportunities out there, but you want to evaluate your decision in reference to the next best thing you could have done instead. And if it comes out that in comparing what you're making today, $8,000, let's say, okay, compared to what you would be doing otherwise, $60,000 instead, because you get the salary plus the rental income, well, $70,000 is better than $60,000, so you ought to do the job that gives you $70,000 in profit. You should do the one that makes you more money, the most money. And that's a decision you can evaluate when you consider economic profit. But if you only look at accounting profit, you're not making a comparison to anything else. You're just saying, well, I make $70,000. Maybe that's good. Maybe that's bad. I don't know if that's how that compares to my other possibilities or other potentials. Right? So accounting profit, very useful, necessary in order to calculate, the functioning of the business, in order to evaluate how much you have to pay taxes on, this and that. But it's not what you need exclusively in order to make the economic decision about whether to produce a particular good or not. Here's the summation here. Sole proprietorship salary with the gift shop, if they just run the gift shop itself, they're going to make $70,000. The sole proprietorship salary with the alternative, next best opportunity, is going to be $60,000. You maximize your profit because the economic profit, EP, is greater than 0. You should do the gift shop. If the economic profit is less than 0, then you shouldn't produce the gift shop. You should go into the alternative opportunity, because the alternative is going to make you more money than operating the gift shop. All right, so economic profit maximization guarantees that a firm is producing the good in which you have a comparative advantage. Remember what I told you last time when we did the Smith & Jones in production and said, look, Smith is going to try to maximize his production, and that means he should produce nothing but oranges. And Jones is going to maximize profit by producing nothing but apples. And if a firm, or if in general a business, moves in the direction of making as much money as possible, then that's going to be the signal they need to follow in order to satisfy the condition of producing according to comparative advantage. And again, why do we want to do that? Or why would we want to do that? Because producing by comparative advantage expands the production possibility set. It gets you out to the frontier. It enables you to produce more goods with fewer resources. So producing according to a comparative advantage is a good thing, not just for the individuals themselves, but for society overall. All right, but there's one big caveat. You have to make as much money as you can, but you still are subject to the ethical constraints or principles that we highlighted previously. So this is not a suggestion to go out and make as much money any way you can, because there's lots of ways to make money where you're cheating other people out of their funds, you're giving them things that they don't want, you're stealing surreptitiously from them in one way or another, and those might be profitable enterprises. And in fact, that might make you more money than anything else. But that's not what the suggestion is here, because you've got to comport with those particular ethical principles when you're making your profit maximizing decision. Only then can we be assured that we've got a good, efficient economic outcome, in other words. Okay? So that's the distinction between economic and accounting profit.